This is the Average Guy Network, and you have found Financial Tech and the Guide Rock Capital Management Weekly Commentary for the week of May 13th, 2013. I'm your host, Jim Collison, broadcasting live from the AverageGuy.tv studios here in Bellevue, Nebraska. And, of course, we post the show each week, including the written commentary from Andrew out at the AverageGuy.tv. Financial Tech brings you the latest market commentary from the award-winning Andrew Hunt, CFP and president of Guide Rock Capital Management, located right here in Omaha, Nebraska. If you'd like to receive a free copy of the written commentary in advance, just send us an email, andrew_hunt@guiderockcapital.com, and put subscribe in the subject. Shoot, put anything in the subject. Just let Andrew know you want to subscribe to it. And if you have questions or comments that we can read or answer on the show, you can just send us an email. Same address, andrew_hunt@guiderockcapital.com. Of course, you can find us both on Twitter. I am at Jay Collison, and Andrew is at Andrew D. Hunt. Andrew, another great week at Gallup. It's another great week to see you. How you doing this evening, and what do you have for us?
You know, I'm great, Jim. I just had a bowl of some delicious ice cream, so
Nice.
I'm ready to do a podcast. So, well, you know, there's been an old adage goes something like this. It says, "Sell in May and go away." It was a maxim which, according to Investopedia, encourages investors to sell his or her stock holdings in May and get back into the equity markets in November. Well, those who adhered to that old adage may be pondering averages and exceptions right now, because during the first 2 weeks of the month, the Dow Jones Industrials Average, the Standard & Poor's 500, and the Russell 2000 all reached new highs. The Dow passed 15,000, the S&P reached 1,600, and the Russell 2000 hit 968. Bulls are in the majority among investors. There is some bearish sentiment out there. There's a bull and bear wise index that measures that sentiment, and that's where some of that bearish sentiment is coming from. The expectations are changing maybe a little bit, and that could be reflected in the CNN Money's Fear and Greed Index. That index showed that investor sentiment has shifted from fear 1 year ago to extreme, quote unquote, extreme greed last week. That's pretty interesting, a pretty interesting metric. So this index, the premise of it, measures 7 indicators, and it's based on the fact or the idea that investors are driven primarily by 2 emotions, fear and greed. And when investors are fearful, stock markets may fall more than they should. And when investors are greedy, markets may be pushed higher than they should be. That's kind of interesting. Investors' inclinations towards stocks may be one of the reasons for declines in the value of gold and commodities last week. And frankly, there wasn't really a lot of economic news last week, but what little there was positive. The Labor Department announced the number of Americans filing initial claims for jobless benefits dropped unexpectedly. Approximately 323,000 people filed for unemployment benefits, which, believe it or not, was about the same number that filed each week before the recession back in December 2007. So pretty interesting to take a look at that. Perceived economic strength in the U.S. The U.S. dollar to gain against many of the 16 major world economies, major world currencies last week, excuse me, as well as 24 emerging currencies tracked by Bloomberg.com. So lots of stuff going on in the markets last week. Pretty interesting. So changing gears a little bit, I wanted to talk a little bit about this question. Maybe you've thought about it with your significant other, maybe you've thought about it on your own, but where will you live during retirement? It's kind of an interesting thing to ponder. You know, maybe it's someplace close to grandkids. Maybe it's someplace close to a favorite vacation spot. I know that's what comes to mind for me right away. But perhaps you want to take a moment and also consider the tax implications of your decision. If your grandkids live in Alaska, Nevada, Wyoming, Mississippi, or Georgia, you're probably okay. Each year, Kiplinger.com reviews the tax rules of each of the 50 states, and they give special consideration to states which offer attractive tax incentives to retirees and provides a list of those states it deems most tax-friendly. For 2012, Kip Clear mentioned those 5 states above that I just mentioned here were the most tax friendly. It's kind of interesting. They also reported the least tax friendly, and those included Connecticut, Vermont, Rhode Island, Montana, and Minnesota. And each one of those have one or more of the following, and this is what made them not very tax friendly. They either had estate or inheritance taxes, high property taxes, no tax breaks on Social Security benefits, or no special treatment for various types of retirement income. I think the bottom line is no matter where you settle, it's really important to evaluate all the factors that are going to affect your retirement income. It's a big deal, and it turns out when you're on a fixed income, it's an even more big deal than you think. So here's a quote for the week. This is from Oscar Wilde, the Irish writer and poet. "Every saint has a past, and every sinner has a future."
Very nice, Andrew. Let me ask you a couple questions. On the tax question, how do you see the state of Nebraska? Some of our listeners are here. We live in the state of Nebraska.
Indeed.
How do we rank in that? Are we kind of middle of the road? Are we towards the top, towards the bottom? Where do you think we stand?
Good question. I'm not a tax expert by any means, so this is merely just my speculation. But I do travel around quite a bit and end up engaging folks quite a bit when we talk about taxes in their particular states. Now, of course, federal tax is the same across all 50 states. That should go without saying, but I think we should clear that up a little bit. So when we start thinking about things like property taxes, estate or inheritance taxes that are germane to the jurisdiction that you're in, Nebraska has really high property tax. We pay a very, very significant levy. I know I live in Omaha proper. I live in Douglas County, and I think my tax levy on my real estate is about 2.7%. It's very, very steep. Whereas in Chicago, some of my clients in Chicago, their tax levy is more like 1.5%. So drastic difference in property tax. Now, on the other hand, Chicago's got a 10% sales tax. So you kind of add that in and you kind of weigh it. Ultimately, states have to derive revenues from something. It's just really where they choose to get that and how it affects our pocketbooks at the end of the day.
Yeah, so maybe a good indicator is to look how each state spends its money and how frugal they are with it. Because they've got to get the pull from somewhere, whether that's taxing you when you buy goods or getting it out of the property. Take a look and see how much those states spend. And in a state like Nebraska, we're a big state. We have a lot of real estate here and not a lot of people.
That's right.
In it. So the road's got to get built, somehow, and those things
right.
have to get paid somehow. Andrew, last question I want to ask you. We're seeing some similar conditions today in the market that we maybe saw in 2007 before, for the beginning of that meltdown. Are there things that you see that are similar, or are there things that you see are vastly different than those two scenarios? We had a little bit of a market run up right before that began. The walls came down on that. Do you see any similarities or any differences that you want to highlight?
Yeah, that's a good question, Jim. I think two things. We have to kind of pull ourselves back and remember what drives stock pricing. Right? When we look at the fundamentals of increasing prices, increasing values for stocks, we have to remember that stock price is a leading indicator of what we expect to happen in the future with that particular company. So, if a stock is trading at $10 a share, we assume that within the next period, we would understand whether or not it's really worth that $10 a share. And stock price is driven by earnings. Profit, if you will. A company's value ultimately, after all the accounting smoke and mirrors are completed, ultimately it comes down to did you or did you not make money? And over the last 5 years, companies have gotten really, really, really good at making money with less. Less people, less inputs, more reliance on technology. And so I think some of this run up in the stock market is probably justified because companies are profitable. However, we always have to step back a little bit and say, hey, when these justified earnings start to run out, when we don't see as much innovation, when we don't see as much profit, or maybe when firms are fairly valued, our stock price is really just running up because of speculation, and that's the thing you have to look out for. So I think there are similarities but there are differences as well. And I would just encourage investors, like you always say every week, hey, educate yourself and be smart about your investing.
Yeah, for sure. Well, thanks for joining us tonight, Andrew. Always good to have you on the podcast. And I'll remind folks that if you're looking for an easy way to listen to this each week, maybe you're coming out to the site and you're listening to it via YouTube or the audio player that's on there or on your smartphone. You can actually listen to the podcast now right off your smartphone, right from the adage.tv at the post. But an easy way to make sure you do get it every week is to listen to that on Stitcher. Just head out to Stitcher.com. It's available on Android and iPhone platforms, just about any browser you can think of, both PC and Mac. You can listen to the podcast. It's right there, all aggregated for you, and no problem downloading it. Just go out to Stitcher.com, search for Financial Tech. Home Tech's the other one. Search for Financial Tech and get that set up. Many of you have, and you can get it each week as we make this podcast available to you. Be sure to visit Guide Rock Capital at guiderockcapital.com. Follow Andrew on Twitter at Andrew D. Hunt, and get all the show notes available out at the averageguy.tv. For this episode, I think we are /FT128. Andrew, I have a theory. The market's been doing well, and it started doing really well when we started podcasting. So I think we're probably, no, just kidding. Now, Andrew and I like to say thanks for listening, and we'll catch up with you next week. And like Andrew said, remember, be smart about your investing. Guide Rock Capital Management, Inc., or Guide Rock, is a registered investment advisor that is registered with the state of Nebraska and located in Omaha, Nebraska. Guide Rock and its representatives are in compliance with the current registration requirements imposed upon investment advisors in the states in which they maintain clients. Guide Rock may only transact business in those states in which it is registered or qualifies for an exemption or exclusion from registration requirements. Important information describing Guide Rock's business operations, services, and fees can be viewed on the SEC's website at www.advisorinfo.sec.gov. Guide Rock will provide Form ADV Part 2, which serves as the firm's disclosure document to all clients. Copies of Form ADV Part 2 are also available to interested parties upon request. All investment strategies have the potential for profit or loss. Past performance is not indicative of future results. No current or prospective clients should assume that the future performance of any specific investment strategy, or product made reference to directly or indirectly on this video, website, or indirectly via hyperlink or any affiliated third-party website will be profitable or equal to past performance levels.